Hey, this is Justin with DayTradeTheMarkets.com on Thursday, July 18th, 2013. And if you saw yesterday's video that I did, it talked about basic strategy for when the market's in consolidation versus when the market is breaking out in vertical, and some ways that you can determine when that is happening. So if you haven't seen that, I would highly recommend you check out that video, and I've linked to it below, so you can check that out as well. Well, today was one of those occasions where we had a breakout of consolidation, which is some of the best opportunities that you can find in trading. And I just wanted to show two very similar examples in both the E-mini S&P and then in crude oil as well. So, heading into the day, obviously our bigger picture bias was up, and we knew that, and we've been talking about this for a few days, we knew this 1680 level was a pretty good overhead resistance, and the market's been knocking on that a few times. Well, today it knocked on there again, but this time, instead of quickly being rejected like happened yesterday, you can see that we had this level 3 or extreme buying aggression bar that started just below the low, closed a point above the high. The market stayed above, tested toward the low, came down toward the 1680, and then just blasted off. That's a very good sign that we're breaking out of that longer term consolidation that we were able to identify heading into the day, and that we wanted to see how the market would react when we test there. So when the market tested this level, it reacted with extreme buying aggression and then follow through. So that's a very good sign that a vertical move is underway, and obviously the market rallied 8 to 10 points before going to more of a two-sided action where you can see some selling starting to come into the market. Okay, so obviously that's one of the ideal situations where we're testing long-term highs. We know that there's potential resistance there. The market breaks out and does so on extreme buying aggression. That's pretty much telling us we're into a vertical, and somehow we want to ride this train, we want to get on board. So then the question becomes, how do you go about doing that? What is your strategy? Well, we like to always talk about things in terms of not being blinded by ABC trade rules, but instead thinking about the quality of opportunity versus the amount of risk you would have to take advantage of that opportunity. So, in this case, the opportunity is outstanding. You know that we're breaking out from consolidation to a vertical. That's one of the best opportunities that you can have. We know that it's in line with our bigger picture bias. We know we're testing long-term highs, and it's there's no resistance ahead of us, so we know that it's really setting up nicely. So then we know the opportunity is great. So then how do we manage risk? How do we do that? Well, one way to do it is just to buy the breakout as soon as that happens. Okay, the idea here is you need a little bit more. You're taking a little more dollar risk, but you're not going to risk missing out on this great opportunity. That's one way to do it. Another way to do it is to say, define how much risk you want to take. And the way that we like to think about that is, where is our wrong point, or where do we need to place our stop so that we don't get stopped out before we're actually wrong? So often, in the name of keeping our stops or our dollar risk tight, people put stops so tight that they're actually not wrong. The reason they got in the trade is still valid, but they actually get stopped out. So in this case, we know that this 1680 level should act as support. Okay, we know this green area should act as support. We know that the low of a level 3 buying extreme buying aggression bar should act as support. So we know that our stop needs to be somewhere below those factors. Okay, that would be a wrong point. So it needs to be 2 or 3 or 4 ticks below the low of this level 3 bar, and that's this green zone. So you can reverse engineer that and put a limit order in based on how much are you willing to risk. A point and a half? Are you willing to risk 2 points, and just put a limit order in that way? Or like I said, now the risk on that is that this thing takes off without you, okay, and you miss out. Or you can just buy it as soon as that bar closes, buy the breakout, which is right here. Now you've got a little more risk. You've got 2.5 points of risk, but you're not taking the chance of missing out. So it's a situation of understanding the context of the market and understanding that we're probably shifting from a consolidating market to a vertical or breaking out market. This is an outstanding opportunity. We've got a lot to work with in terms of bigger picture support there. Now that we've busted through it, shorter term support. Our filter's strongly bullish. A lot is working in our favor. So we somehow want to be able to ride the train. We want to be able to jump on board that vertical move. Okay, so that's the thought process that goes into it. So it's not black and white, but it's a matter of trying to make sense of what is going on. And like I said, breakout, how do we get on board? How do we do that? Do we want to manage our risk? Do we want to just jump in and take more risk knowing the opportunity is great? There's no right or wrong answer, but those are the questions that you ask yourself if you want to have successful type trading endeavors. Very similar situation happened in crude oil today. So let me have a look at that. Here is The crude. Now the crude's been in consolidation for about a week now, and this level at 06.95 was kind of the overhead resistance. So a very, very similar situation in the crude oil. You can see we break out of that early in the session on a level 3 bar, and here's another one. So again, we know that this, we've got a strong green filter. Our bigger picture bias is up. This 0695 has been the recent high in the consolidation over the past week or so. So we know this is a good spot. We know that this thing is likely to break out and going to move higher, and we want to somehow ride this train. In other words, we've shifted from the consolidation where we're looking to fade the, sell the highs and buy the lows of consolidation to more of a breakout phase where we're looking to ride the wave. Okay, and so that has happened, so we ask ourselves, how do we get in? Well, we know our stop needs to be below the low of this level 3 bar. We know it needs to be below this, support zone at 0695. It needs to be somewhere in here. So you can kind of reverse engineer that dollar-wise to how much are you willing to risk dollar-wise and place a limit order in there. Or you can just buy at the low of the level 3 bar, which should work, or you can just buy the breakout. Now you have more risk if you buy it at that point, but it's opportunity versus risk. How much are you willing to risk relating to the quality of the opportunity? That's again the thought process. So it's not about being this black and white, setup trader, but it's instead learning, and this is what we teach all the time, and this is what the tool can really help you do, learning what are the bigger picture levels to watch and how does the market react. Well, bigger picture resistance, we bust through it on very strong or extreme buying aggression. This thing wants to head higher. How do you get on board? Several different ways. Minimal risk, maximum risk. The maximum risk implies that you're not going to miss out on the opportunity. If you wait for minimal risk, there's a chance you miss out on the opportunity, but you don't have as much dollar risk. That's the trade-off. Okay, so I know I'm kind of talking fast, but hopefully you're grasping what I said. And then as this thing's moving higher, obviously you have other opportunities as well. We have another level 3 bar up here, another support zone up here with the green filter, bigger picture bias is up. Obviously that's very low risk trade opportunity right there. Same thing here. We're into more of a shorter term consolidation when we get to this area, and obviously in a consolidation scenario, we know that being a seller at the lows of a buyer at the lows of consolidation makes good sense, especially if it's in line with our bigger picture bias, which this is. So getting long anywhere in this area in here is obviously very low risk, high reward opportunity. Same thing in this area here, and so forth. So hopefully that makes sense. Where like I said, if you haven't seen the video that we did yesterday, please, I would recommend that you take a look at it. It just talks about general strategy and concepts for, number one, identifying when a market's in more of a vertical or breakout phase versus more of a choppy or consolidating phase. And then number two, strategies that you can use or ideal strategies for that scenario. Well, yesterday was a consolidation type of a day. Today was a breakout type of a day. And so different strategies would apply, but you still, if you can put that in context and you understand that in real time, and then you have tools that are telling you that this is real, this isn't just noise, this is real, things are happening, then you're putting the edge much more in your favor. So hopefully that makes sense. Let us know if you have any questions about that, and have a good afternoon, evening, and so forth. Talk to you soon.